Startup slowdown, funding winter, down rounds. Phrases that have been in the headlines for quite a while now, as money stopped being cheap and efficiency took over exuberance. Crunchbase data shows that global funding in the first quarter of this year is down a whopping 50%, reaching $76 billion globally. And India is far from immune. Reports indicate that investment into Indian startups is down 75% in the Jan to March period. But this may not be all full gloom and doom, as the guest on today's show will tell us that there is a bitter pill of reality that founders as well as funders have to swallow to take advantage of a fast-changing geopolitical reality where tech is transcending borders and economics is trumping politics and policies. In a very special episode of The Morning Brief, our host Anupriya along with ET's Apoorva Mittal sit down with a veteran venture capitalist that has backed legendary companies such as Stripe, Snap, Samsara, Airbnb, Canva, and many more. Hemant Taneja from Silicon Valley, CEO and MD of General Catalyst, along with best-selling author Fareed Zakaria, who as a thought partner with Hemant has been traveling across the country, meeting startup founders in India to assess who is ready to swim as the tide continues to turn. It's 28th of April and you're listening to the Changing World Order for VCs on The Morning Brief. Thank you, Fareed and Hemant, for being here. And I'm going to start with Hemant and Fareed jump in. What is Fareed Zakaria doing in Bombay, talking to me on a VC roundtable? How does this partnership and what is this all about?
Well, we've had a total mind meld in understanding how the changing geopolitics is going to impact innovation and businesses. And as we've written about in the past, we're going into an era where politics does trump business for a whole category of businesses. And a lot of what we're trying to figure out is, well, how does that really impact the venture capital landscape? So our conversations have been in translating the macro changes into the micro opportunities and innovation.
Yeah, I mean, it began with, we were introduced by some mutual friends, and then Hemant was at a talk I was giving at which I was describing the changing geopolitical landscape, and he came up to me afterwards and said, you know, when you think about how things have changed, venture capital is an industry that grew up in very unusual circumstances. Period after the Cold War, period of extraordinary geopolitical stability, the creation of a single global market, open trade, open technology platforms. And we should talk about where this goes now. And we started to talk more and more, and we discovered that there really was a synergy in trying to think about this from, on one hand, the geopolitical point of view, on the other hand, as Hemant says, the kind of microeconomic point of view. You know, what does this mean on the ground for capital, for companies? And it's been an incredibly fruitful partnership.
So it's obviously shaping how your investment philosophy is working, but you touched upon something which you said, what has changed over the last 3 decades almost. You called it the golden era for the venture capitalists. The biggest change that we've seen, which has impacted politics, it's impacted governance, is the end of the beautiful zero money era as well. Money is no longer free, money is no longer cheap. It's one of the sharpest U-turns. It's impacted politics, it's impacted how voters are voting across the world as well with inflation. How much has that played into this economics over politics play as well? And what's the funding scenario looking like right now?
Let me start with the broader question and then toss it over to him. The move from zero money is itself very much a part and a consequence of this change in geopolitics, because really the end of the Cold War, the opening up of the global economy, the acceleration of the information revolution produced two giant global deflation machines, if you want to think about it in that way simply, which is China and software. And what ended up happening is the rise of the extraordinary amount of opportunity and manufacturing particularly, but services as well in emerging markets, depressed prices, particularly wage prices, labor prices, right, which is where the core of inflation is always wage inflation. And the second, of course, was information technology. So both of these pumping prices down produced an era in which there was really no inflation. Once you start to see the reversal of all this, that's why I believe the return of inflation is a structural phenomenon. It may not stay at 5-6%, but It's going to be very difficult to imagine a world in which you have zero inflation again, now that we have turned the corner.
Yeah, I do think that has a pretty major impact on what it means for businesses. If you think about the last 15, 20 years where money has essentially been free, software companies have been able to build, frankly, with little regard for profitability. And what you're now seeing is the focus back on profitability, the focus back on trying to build these businesses in a way that they're capital efficient. So I think at a micro level, you are seeing that discipline back in the ecosystem. And the other thing that obviously is changing is that U.S. platforms powering the entire world, perhaps sans China, isn't what other nation states want. So if you think about what happened with COVID, or if you think about the Ukraine war, every country wants their own vaccine strategy after COVID. And Europe needs to figure out how to be energy resilient on its own. And so when these kinds of geopolitical factors also set in, then the reconfiguration of the innovation ecosystems and how these businesses get built in categories like defense, manufacturing, supply chain, healthcare, with regard for local interests, that has a profound effect on what the landscape is going to look like where us as investors are playing.
And have founders accepted this change? Like, has it been difficult for the founders you've interacted with to soak the fact in that there is this discipline that's expected of them now after this go-go period?
I'll answer that on a short-term basis and a long horizon basis. I think on a short-term basis, it's a mix. There are founders that completely understood that this is a structural shift to the high interest rate era, and they were very quick to realigning their capital, their investment strategies, and their talent base to the cadence that can be successful in terms of business building in this era. And then there's some that are still in denial because perhaps they were overcapitalized and they think they have the runway and they're hoping the world might change. I do think reality is setting in for more and more founders in that regard. Long term, I do think when you think about companies that start today, those founders are much more focused on capital efficiency. They are focused on understanding that some of those businesses aren't perhaps being built in a free market environment anymore. And they need to have a deeper regard for how to build businesses that interact with policy and policymakers. So the cadence on a long-term basis of a lot of these companies that fit in our global resilience category that we've written about is different from what it used to be sort of a decade ago.
If you look at the number of zombie companies that had flourished during this low interest rate era, it's fundamentally related to that. And I think Ruchir Sharma has that number in the US at 20%. I think everywhere in the world, it's Warren Buffett's line, only when the tide goes out do you see who's swimming naked. But the tide is going out. And in a way, it's a very healthy return to some degree of discipline about, even within a company, what project makes sense. And if a project has to meet a higher hurdle rate, it's probably going to be more sustainable in the long run.
And by the way, as investors, the investors that haven't been doing this for a long time, this is a really scary time. But firms like ours that have seen these types of environments multiple times in our careers, this is a really exciting time. A, because your existing companies learn to be much better and resilient and profitable. The second is, as human capital unlocks in these times, the companies that start in today's era, historically, you would say, end up being the most successful because they have the discipline, they're building in a resource-constrained environment, and they're willing to take risk in this kind of time frame. And so from our standpoint, this is a great time as the tide does go out, to Fareed's point.
Yeah, and think about what interest rates were when Microsoft or Apple were founded, right? I mean, they were envisioning returns and projects that made sense even in that interest rate environment.
So you definitely don't expect zero to come back in terms of the interest rate or the inflation numbers down to 2% as well. So that reality is gone. Those days are definitely.
Think about every government, what it is saying. It wants to take India. Prime Minister Modi says he wants made in India. He wants supply chains to come here. He wants to create Indian champions. But all of that means you're choosing not the lowest cost way to do something. You are choosing to maximize certain political goals. Look at what even India is doing on the environment. These are all completely understandable, often laudable goals, but they are not low cost goals, right? So and every country is doing that. So if every country is choosing to do something that is not low cost and high efficiency, you're adding structural inflation into the mix.
Are you seeing a big shakeup in the startup How is it different than 2019, or when you would have met when it was the first time you were making investments? The ground reality of funding was different. The political economic environment was not very different. There is changes with what's happened around the world, as you're saying. But have the conversations changed in India in any way?
There's a few things. First thing is entrepreneurship is very robust because finally you saw the IPO market open up in India in this last cycle and a lot of companies got created. So that gives hope to every IIT grad that maybe they should go become an entrepreneur versus going and working in a multinational. So that's a structural shift that we're seeing, especially during this visit. The second thing is the overcapitalization also happened here, just like it happened in the US and other ecosystems. And the fact that these companies are working through the discipline of building with profitability, they're all dealing with the same issues I see in the United States. So that is not different at all. The thing that I'm not seeing here is there is this acceleration of this cloud cycle with AI and GPT-4 advancements. And I would say we probably saw a few hundred companies already this year in the US working on that area. And I would have expected that you would start to see more innovation in that area this time around here, because if you think about the national resilience interests, you would think that India wants to be a player in AI. And so I was really hoping to see that there are a lot of projects that are starting to happen there. And I haven't so far seen that. Maybe it's happening and we just haven't come across it. But if India is going to be globally competitive in this next software cycle, then you definitely want to see the AI ecosystem developing here in a more robust way than what seems to be apparent to me.
And Hemant, if you had to venture a guess, why do you think we aren't seeing as many AI startups coming out of India?
The concentration of talent around AI is in Silicon Valley. In fact, a lot of my friends that have moved to places like Austin and Miami have come back because they see that if they want to be part of this next AI-based technology cycle, they need to really be at the ground floor. That's where Google is, that's where OpenAI is, that's where Meta's team is. And so that network effect is playing out. And we deeply care about the innovation ecosystem here thriving. So part of what we're looking to figure out is how do we also catalyze that here in India?
The thing to remember about India is it's still, in aggregate terms, a poor country. So per capita GDP is about 2,400, I think. It's natural that it's not going to be at the cutting edge of the technology chain. What's extraordinary is how much is happening, and that is because of two revolutions, the Aadhaar revolution and the Geo revolution. So you create the ability to do identity and payments and then eventually do something with the data, digital wallet, and the fact that everyone is connected to the internet through a smartphone. So what you're seeing is an extraordinary rise in the number of entrepreneurs who are interested in doing something in that new ecosystem that's been created. But it's not cutting edge. And as Hemant was saying, it's nowhere near where the US is. Again, totally understandable. One of the things we are trying to collaborate on, helping India leapfrog and move much further ahead technologically, and trying to create a kind of permanent corridor between the US and India to help India's digital transformation, to help build the US-India alliance, to help solidify strengthen the contacts between the two countries and the two societies and the two tech ecosystems in a way maybe that there exists already between, say, the United States and Israel. So something on that order. And that might begin to make this cutting edge stuff happen.
So I want to touch upon that. So you actually are at a very good vantage point because you're sitting in Silicon Valley in one point, you're seeing how fast things move there. And you're seeing a country which has the potential, has 1 billion people, most populous nation in the world now. So you're at a vantage point to be able to pick sectors, not companies, but sectors or areas where you see that where AI can give you maximum efficiency returns and the profitability patience to pay out. What are some of those sectors? Is it the large mass consumer, but not consumer in terms of consumption, but more healthcare, education? How does the balance change?
See, we think a lot about 4 areas at the firm, and we've actually been investing in India already. We've got 24 companies here across those areas. Healthcare is obviously one. The second is around how do you think about fintech and democratizing opportunity? The third is around AI. And, it's interesting when you think about India, where if India is going to become the next China and go through this massive sort of modernization, it's going to need a workforce that is upskilled and reskilled to be able to take advantage of the opportunities that are in front of it. So the question is, how are you going to develop that workforce, and what role does AI play in augmenting that human potential to further accelerate productivity? I think that's a really interesting macro theme here. And last is resilience. You have to think about climate change. You have to think about defense. You have to think about food. And we think we are very focused on, well, how are these supply chains going to develop? How can interesting technologies be brought from the US and others and commercialized in a way that it catalyzes local jobs, local opportunity? And so at a macro level, we're thinking about all four of those themes. Same themes, by the way, that we have in the United States, and seeing from first principles, what does it really mean to bring them in from an innovation perspective here?
Just to clarify, the sectors and themes that you're looking at when you talk about this reglobalization, everybody's, as you said, wants their own vaccine policy, wants their own chip manufacturing as well. The US is bringing back chip making into its own borders. We had Tim Cook come in last week. You're following another visit as well. So the India-China plus one Fareed come in, and this is a strong and loud resonance in policy right now. It's been very loud from the government as well. Made in India, made from India, made for India. There are a lot, that word changes in the middle quite often. But are we looking at India developing for itself? Are we looking at India building for the world? Because the latter will take a lot more patience at this point. So how are you seeing it?
It's a very good question, because we don't know where this is going to go, because this is a kind of a unique experiment in deep degrees of globalization and economic interdependence, but at the same time rising geopolitical tensions and this desire for national resilience. So, our thesis is that you're not going to see a complete deglobalization, not going to see complete decoupling. What you're going to see is selective decoupling in certain areas, but there's going to be lots of global markets and global supply chains and global products. So within that, how do you navigate? It really is going to be a case-by-case basis. And, they're going to be, even in chips, it's really only the high-end chips that the US is trying to make sure that, the Chinese don't have access to. So when you think about it in those terms, what is going to be regarded as enough of a capacity, whether it's with regard to pandemic preparedness or technology, it's not entirely clear. But I do think India can't just manufacture for India. I don't think that model, which really it was India in the 1950s, 60s, making Premier Padminis and ambassador cars, is going to work. What you make, you have to make for a global market at global standards.
And it's a continuum, right? When you think about the software industry, India can actually build for the world today. There's a lot of talent, and we should be able to do that. If you look at areas like semiconductor manufacturing, India needs to figure out how to get its own supply chain up and running, build for India first. And the reality is that if you can support the population with the per capita income that it has today, it should be globally competitive from a cost standpoint. The key is to be innovative and not think about suboptimal products. But is Geo a suboptimal product? And it's actually a better service than a lot of what I see in the United States. So I do think this leapfrog opportunity is going to be there. It's just a continuum in terms of how prepared are they across the different industries to be able to do so.
So there's a huge focus on startups figuring out their path to profitability. In an ecosystem where large consumer internet companies are yet to turn profit, how are you evaluating a startup's path to profitability, be it early stage or later stage?
I think path to profitability where you have, at a basic level, profit in the products that you're trying to sell comes down to the discipline around what is the right growth rate for the company that we're about to discuss, right? So the physics of each company sort of dictates what that is. And a lot of what happened, and the reason you have a lot of these companies highly unprofitable over the last couple of years, because the only thing the market valued was growth. And now we're reverting back from there to say, no, it really is going to be about profitability, and you can't be running unprofitably for the next 4, 8, 12 quarters anymore. So the question is, what is the right growth rate that allows you to be profitable in the next few quarters?
I'm going to read out something. There was a tweet from Nitin Kamath, Zerodha founder, last evening actually. I think the number of founders and leaders, especially at late-stage startups, quitting will only increase, making it harder for businesses to survive this funding winter. This is because of liquidation preferences and the disconnect between valuations and business fundamentals. There's obviously a large concern. I mean, it's 40 degrees outside, so it's no longer winter, but for the capital's sake, it is funding winter still. So we're obviously hearing very different realities? I mean, we have you here meeting, going to Delhi, going to Bangalore, coming to Bombay. Where is the disconnect? There's a valuation come down, there is patience waning, there is the go-to IPO market is drying up. The reality, once a startup which was multi-billion valuation come down and get hammered by the Lal Street, there's obviously a big disconnect somewhere. So did we have to take this knock on the chin before we settle down to realities?
You have to reconcile the fact that we're talking about a long-term opportunity for India, which has been catalyzed by the geopolitics and reglobalization that we've talked about. I think we're trying to conflate that with the short-term working through a very undisciplined era and getting those companies through that. So first of all, you have to differentiate those two. I think the reality is that there are a lot of companies that have bloated valuations all over the world, not just here. And the reality is that many of them are going to need to have down rounds. And if the founders and the investors aren't pragmatic about saying we have to reset cap charts, that might require taking down rounds from a founder perspective, and that might require from a investor perspective not being aggressive on how the liquidation preferences manifested themselves so that the human capital is motivated. You're essentially rehiring your teams through this capitalization phase to go continue that dream for the next several years. So that's going to come down to the pragmatic nature of the investors and the entrepreneurs. And in some companies that'll align, and some companies will be a situation that the teams are going to feel like there's no economic upside and they're not going to stick around. So the practical reality is that everybody needs to understand a lot of what happened in the last couple of years was irrational, and we have to move past it, and we have to be pragmatic in how we move past it so that everybody understands that all stakeholders need to be taken care of in coming up with those kinds of scenarios.
One of the features of this age we're in is this extraordinary volatility. So I think a good founder is somebody who understands where you are on that cycle. And if you happen to be lucky and you get into a cycle where you can cash out it very quickly, great. But sometimes you don't get those. And think about all the companies that were founded in the US in the funding winter of 2000, 2001, 2002, 2003. Many of those are great companies.
Hemant, following up on what you said earlier, do you think that pragmatism is being showed by the investors in this environment? Because what I was hearing is that investors, in fact, are coming up with more stricter terms and, asking for more anti-dilution provisions, guaranteed returns, etc. What do you have to say about that?
This is the reinvention of the wheel, right? When capital is scarce, the terms skew in the favor of the investors and you get to ask for all these things. When capital is abundant, then you do whatever it takes to get into companies and it becomes founder friendly. The reality is neither is okay, because you want to be aligning with economic structures that are good for investors and employees and the founders. And so these structured equity rounds, which are, by the way, a lot of times being done to preserve the vanity numbers of the older valuations, but at the same time giving enough of a return to the new investors coming in. I think that's silly. I think that's a Band-Aid, and you're much better off taking your medicine, doing a down round, cleaning up the cap chart to the extent that it needs to be cleaned up, and just build from there. Market stocks go up, stocks go down. Markets go through this phase, and being sort of acknowledging that and building with that sort of dynamic from the beginning versus layering on all this complexity on the cap charts to preserve a valuation number. I think that's a mistake. And I'm hoping more and more founders will realize that, take their medicine and move on.
I want to pivot back to AI for a minute. We also come to a point where technology is going to play a great role in re-globalization, is how you've pegged your Harvard Business Review articles as well that we went through. Will also require a lot of regulation collaboration. We talk at a time where there's talk of let's pause, let's think. You're big proponents of responsible innovation and how that impacts businesses as well. How risk is regulation for businesses right now, especially disruptors? You want to bet on disruptors. You want to be patient with disruptors. But how big a risk is regulation? So there is obviously, it's very, very nimble footing across.
Look, before we talk about regulation, we need to talk about self-regulation. If you think about what happened with technology, and Fareed and I talk a lot about this, the social media revolution and the move fast and break things and all the issues that caused, these advancements in AI and how aggressively moving to commercialize them, sometimes I feel like the ecosystem has forgotten what we just went through over the last 15 years, and we're starting to move fast and break things again. That is not going to end well. So a lot of what we've been writing about and the core tenets of responsible innovation are all about the fact that we have to build with intentionality here, and we need to leverage AI in a way that's explainable, accountable, and transparent. And we need to make sure these design principles of how AI gets adopted are around, first and foremost, augmenting human potential, workforce transformation, as opposed to doing it in a way that there end up being unintended consequences that we don't know how to deal with when they arise. The other thing I would say is the mismatch of expertise around AI in the tech sector versus the policy sector in the United States is massive. So this idea that regulators would even know how to regulate this is today impractical. So the collaboration between tech and policy to make sure that there's a common ground in how to commercialize that innovation is extremely important. I was just going to just one more point, which is, and the answer can't be let's stop or let's pause, because on one side we're dealing with how do you responsibly take advantage of AI, which has a potential to be an incredible technology. On the other side, there is a US-China arms race around AI, and you don't want to see the nation falling behind. And same thing for India, which is why we're encouraging to say start activating more innovation around AI, because you do want to build that capability, because it'll ultimately be a competitive advantage for your businesses.
I think we need to think about AI in those terms, where how you think about the way in which you handle it is going to be it is going to shape the future of technology and maybe the future of the world in a sense, because AI is going to be so powerful. And we face these two conflicting desires, one to move very quickly and to, for example, in the US, to beat China, to make sure that the US remains at the cutting edge. And on the other hand, to make sure that you have some kind of architecture that has some kind of guardrails, some kind of values in it, and managing these two tendencies, one to win and the other to create something that actually reflects human values, is going to be a very hard challenge.
I have to ask you this pivot away from China, and I want to just give you a quick analogy. I was speaking to someone who works in the same sector as the VC world and said, at this point, if I even pitch a Chinese company, I think they'll throw me out of the company. This aversion to China, do you think this is transient, or do you think this is a permanent shift in geopolitics that has happened?
Oh, I think this is the biggest structural change in the international system in decades, because what you have developing is a classic rivalry between the two established hegemons, or one established, one rising, depending on how you want to see it. And it's only going to grow. Now, there is, in the process of that growing, we're going to arrive at some kind of modus vivendi, where some way of living with the US and China living with each other. So I think that there will come to be some recognition. The world is too economically interdependent to have total decoupling. China is the biggest market for American farmers. It's the largest importer of American agricultural goods. US does $700 billion of trade with China. India does twice as much trade with China as it does with the US. So all those realities will remain, but the competition will intensify, which means that there will be increasingly areas where there will be carve-outs, whether it's with regard to the highest end of chip making, artificial intelligence, anything relating to space, perhaps anything relating to vaccines and pharma, in particular kinds of vaccine and pharma, certain kinds of social media, right? So now it sounds like I've listed a lot of things, but if you carve those out surgically and leave the rest alone, the question is, can we arrive at an equilibrium like that? And your friend, maybe in a few years, will be able to say, I know I'm pitching a Chinese company, but it's a consumer goods company. It has no national security implications. It has no information security implications. And here's why it's a great deal. That's, to me, a very likely outcome. The other outcome would be a very suboptimal world. It would be a world in which you ended up really closing down international economy down to national borders.
In the last year and a half, there have been a lot of financial irregularities that have surfaced in both startups in the Silicon Valley and India. What are some of the lessons you think VC industry has taken away from these instances, and how are you trying to address it in your own portfolio companies?
One of the things we've been focusing a lot on, especially here in India, is emphasizing the role of a great CFO and making sure these companies are working with the right audit firms, making sure there's transparency in what's being reported. And part of what we're trying to do is that we engage with these companies at multiple levels. It's not just working with the founder or the CEO only, but it's also really going in the weeds and understanding what is the financial view of the business. and drilling into it and making sure this is correct. Look, fraudulent cases don't happen that often, but they do happen, right? And there's been a few of those here lately, and obviously there are examples of that in the US as well. So to be good fiduciaries of capital for our LPs, we're just deepening our own capabilities and focus on collaborating with the CFO and the financial functions more deeply than, frankly, we used to when we were simply an early stage venture firm.
So is governance a growing concern across the globe?
Governance is increasingly being valued. And I think one of the main reasons, and I've written about this before, is that the role of technology is becoming so much more important. You're not building software companies that just drive efficiency. You're rebuilding institutions in healthcare and fintech and education and so on. And so the responsibility in terms of what these companies do for stakeholders, consumers, and businesses is so much higher that us as fiduciaries for these companies have to be much more sophisticated in how we think about governance than we used to. These companies are now scaling to far larger numbers than they used to, because tech companies, you get it to a $50, $100 million in revenue, you're a market leader in your little software category, and you go public. And venture capitalists would sort of hand over to the public market investors at that point. Well, that's not what we do now. And if you look at companies like Stripe and others that we work with that are massive and they're still private, well, how do you really provide governance to companies like that are at that scale, at that level of responsibility in society, and when the increasing focus on sustainability? How do these companies really think about their responsibility towards not only their customers and employees and partners, but also society as a whole?
You know, as we wrap out, I have to ask Fareed this question because we're in very interesting geopolitical times. There is no G7 country which has an election. This year, I think it's the first time in 23 years that not a single G7 country, so this up to the century for this matter, has an election. A lot of unorthodox leaders have popped across the world and they've been punished by the markets. How do you see the unmentioned reform era? There are countries across the globe which have, India is obviously much larger. There's Turkey, there was Bangladesh at one point. There were these spots of hope. And how do you see the geopolitical arena outside the big four that show up on the G7s and the G20s working?
So we're definitely in an age where the movement toward market reforms has stalled. And that is largely because there has been this populist revolt everywhere in the world of people who have benefited less over the last 20 or 30 years. These are people generally less educated, living in rural areas, less cosmopolitan. And it's actually true that they have benefited less. Not everywhere in the world. I mean, it varies. But as a general proposition, the last 30 or 40 years have been a period where the entire structure of the international economy is moving toward knowledge work. And if you are in that context, you are not a knowledge worker in some sense, it's been hard. But I do think that when you look at places like India, what you see is that the understanding that there needs to be reform is still very strong, because a country like India wants to move hundreds of millions of people out of poverty. And truth of the matter is there is no way to do it better than to create better markets, more efficient markets. Obviously, you want to try to bring everyone along, and that sometimes means the state has to spend more resources in those areas and on those people. But I think that what you're really seeing is a division between the Indonesias and Indias on the one hand, which are still reforming, and the Turkeys and Bolivias of the world, where you have a kind of an effort to return to the kind of populist economics of the 1970s. But as you say, those markets are punishing them. They're not getting any growth. People are not moving out of poverty. And you have to assume that over time, people will realize that. There has been a movement away from it in some ways in Western countries as well. But the truth is those countries are rich. But India has to strive for some kind of growth-oriented strategy. So I still think that when you look at much of East Asia, you're seeing some in Africa, you are still seeing that people understand, look, keep your eye on the prize. You're trying to get people out of poverty. And the only way you can do that is to help make markets work for them rather than against them.
I have to ask you before we let you go, You followed Tim Cook, and he was in the headlines for eating a vada pav with Madhuri Dixit. What has been on your itinerary? What has been the highlight? Obviously, meeting founders, but what are some of the fun things that you've managed to pack into this very tight trip here?
Well, so far it's been meeting a lot of entrepreneurs. And honestly, it's been fun just listening.
No celebrity entrepreneurs.
No celeb.
Well, we met
celebrity.
There's no one to name drop, but
Yeah.
we met pretty much everyone.
Yeah, but I think the thing I'm walking away with is the sheer ambition that the very best founders and leaders here have in how they're viewing this opportunity on a long-term basis. I mean, some of the ideas we've heard, the scale and the long-term thinking that's being executed against is just phenomenal. So that's more delicious than pav bhaji.
Fareed, what's been on your itinerary? I know this is part of family here as well in Bombay, but
it's all coming to India is always a huge pleasure for me. I entirely agree with what Hemant said. The level of ambition, particularly at the higher end of the businessmen who are now really thinking on a global scale, is amazing. Food-wise, for me, you can't beat pani puri and dosas. Those are my two weaknesses.
Oh, well, on that note, thank you, gentlemen, for being here, and have a great, safe trip back home. And I'm sure we'll catch up with you again, and it'll get better from here. So.
Thank you so much.
Better behave balance sheets, founders, and funders. That's the message loud and clear from Silicon Valley to startups. General Catalyst, which has raised over $14 billion since its inception, is a late entrant into India, but is betting big on the Der Aay Durust Aay phrase, as valuations wipe out irrationality and VCs balance out patience and profits in the new world order, where tech will hopefully help India script a new startup story, one that may not be as exuberant, but definitely just as exhilarating. You've been listening to The Changing World Order for VCs in the Morning Brief. A shout out to the team that helped put this together. Producers Vinay Joshi and Sumit Pandey, sound engineer Indranil Bhattacharjee and Rajas Nayak, executive producers Arajit Burman, Anirban Chaudhary and myself. Thank you for listening in and have a great weekend.